For 50 years, moving money has meant passing through the same stack: a bank, a card network, a processor, a middleman, taking a cut you never see. Every swipe, every transfer, every payment across a border moved through a system someone else controlled, on a schedule someone else set. But underneath that system, a second one has been quietly growing. It runs 24 hours a day, every day. It settles in seconds, anywhere on Earth. It can move $1 without a bank branch, without a card network, sometimes without even touching the country where that dollar was created. These are stablecoins. In 2025, they moved more than $12 trillion. And that is exactly why banks stopped ignoring crypto. They were never scared of the coins. They are scared of the rails. So what is a stablecoin actually? Strip away the crypto branding and it's simple: a digital token issued on a blockchain, backed one-to-one by a real dollar sitting in reserve, usually cash or short-term treasury bills held by the issuer. One coin, $1, in theory redeemable at any time. That's it. It isn't trying to be a volatile bet, like Bitcoin. It's trying to be boring. A dollar that happens to live on the internet instead of inside a bank's ledger. But being boring is the whole point. A boring dollar that can move at the speed of a text message, settle without a clearinghouse, and get programmed to do things a paper dollar never could. Pay a supplier the instant a shipment clears customs, split automatically between 10 people, refund itself if a condition isn't met. Banks didn't build this. Tech and crypto companies did. And that is the part that should worry any institution that assumed it owned the plumbing of money. Here's the system stablecoins are quietly replacing. You tap your card. That single tap kicks off a relay race. Your bank, the card network, the merchant's bank, a payment processor, sometimes a second processor, each one taking a fee, each one adding a delay, each one a place the transaction can be paused, flagged, or reversed. Cross a border, and it gets worse. Currency conversion, correspondent banks, wire fees stacked on wire fees. A payment that should take a second can take days. A transfer that should cost pennies can cost the sender real money before it even reaches the recipient. None of this is a conspiracy. It's 50 years of infrastructure built one institution at a time. But it means every dollar you send is taxed, slightly, by the number of hands it has to pass through to get there. Now, put the same payment on a stablecoin rail, wallet to wallet, no card network in the middle, no correspondent bank chain. The transaction settles on a public ledger in seconds, at any hour, on any day of the year. It doesn't know what a bank holiday is, and it's programmable. Money that can carry its own instructions, releasing only when a condition is met, splitting itself, refunding itself, without a human approving each step. That's the shift hiding inside a number most people never saw. In 2025, adjusted stablecoin transaction volume, filtering out bot and exchange internal activity, passed $12 trillion, nudging up against Visa's own annual payment volume of roughly $14 trillion. Counting all stablecoin activity, including trading and transfers, the total is even larger, over $30 trillion. This is not a niche experiment anymore. This is a parallel payment network already operating at the scale of the one banks and card networks have run for half a century. The card networks felt this before most people did. In 2026, MasterCard agreed to acquire BVNK, a stablecoin infrastructure company, in a deal worth up to $1.8 billion, the largest stablecoin acquisition to date. BVNK doesn't make a coin. It builds the plumbing that connects stablecoins to the existing banking system across more than 130 countries. MasterCard isn't buying a cryptocurrency, it's buying a rail, the exact piece of infrastructure this entire fight is actually about. Visa has done something similar, launching its own stablecoin settlement network. Stripe paid over $1 billion for a stablecoin platform called Bridge a year earlier. Every major payments company is racing to own a piece of the new rail because the alternative is watching wallets that don't need a card at all route around them completely. Banks aren't just watching. They're building a competing rail of their own, tokenized deposits, a bank account balance turned into a digital token that moves like a stablecoin but stays inside the regulated banking system, still earning the bank its deposit base. The Bank of England has said the quiet part out loud. In May 2026, policymaker Megan Green compared the three systems to a fable. Central bank digital currency is the tortoise, stablecoins are the hare, and tokenized deposits, she said, are the rhino. Her bet, quote, "Tokenized deposits are probably going to take over from stablecoins, and 5 years from now, I suspect we might wonder why we were talking about stablecoins," end quote. That is a central banker on the record, saying the current stablecoin boom might just be a bridge to something banks control instead. The fight over the rail has barely started. None of this is automatically good news. A stablecoin is only as trustworthy as the reserves behind it. And reserves can be mismanaged, misrepresented, or simply insufficient. When Terra USD, an algorithmic stablecoin, lost its dollar peg in May 2022, the collapse erased an estimated $60 billion in value within days. Depegging isn't hypothetical, it has already happened at real scale. There's also the newer, less regulated wallet layer around stablecoins, scam tokens, phishing wallets, and rug pulls that borrow the same stablecoin language to look safe when they aren't. And there's the protection gap. A fraudulent card charge gets reversed by your bank, usually within days, because banks and regulators built consumer protection law around cards over half a century. Send a stablecoin to the wrong wallet or into a scam, and in most cases, there is no chargeback, no dispute process, and often no regulator who will make you whole. Speed and programmability cut both ways. So does removing every human checkpoint from a payment. Strip away the brand names, the coins, the logos, and it comes down to one picture. The old rail, customer, then card network, then issuing bank, then acquiring bank, then merchant. 4 intermediaries, each with a fee, each with a delay, none of them running on Sunday at 3 a.m. The new rail, wallet, stablecoin rail, merchant. One hop, settlement in seconds, every hour of every day. This is the picture that should worry an institution that has spent 50 years sitting profitably in the middle of that first chain. Because when the rail changes, it doesn't matter whose logo is printed on the plastic in your pocket. It matters who owns the pipe. The money actually moves through. The coin is not the product. The rail is the product. So, who wins the rail? Maybe no one cleanly. Maybe regulators force banks and stablecoin issuers into the same rules, and the two rails merge into one regulated system neither side fully controls. Maybe tokenized deposits win, and the banks absorb the technology while keeping the deposits. Or maybe stablecoins keep growing past the point anyone can afford to ignore them. And the card networks that bought their way in end up owning the future instead of losing to it. What's certain is this: the $12 trillion that moved through stablecoin rails in 2025 wasn't a crypto experiment. It was a rehearsal for how money moves next. Banks spent 50 years controlling the pipes. For the first time, someone built a new set of pipes and asked no one's permission. The future of money may not be about which coin you hold. It may be about which rail it travels on.